What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I'm going to go over the pros and cons of SCHD, and I don't believe SCHD is all that, but it's good for dividend growth and it's done well against the S&P. So I have these guys in my traditional IRA, and the one thing with a IRA is you like to have stocks or ETFs that compete with the S&P or beat the S&P. Probably better to beat the S&P because the price per share goes up and your net worth or net asset value goes up over time, and you like dividends that go up and grow over time to let the dividend snowball effect kick in. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. Of course, this is not financial advice, for entertainment purposes only. Disclaimer in the description. Let's check SCHD out right now. So SCHD has done pretty decent against the S&P in the past 5 years. Schwab U.S Dividend Equity ETF is the name. And right there, it is 44.29% up since the past 5 years. And the S&P 500 is up 51.64%. Price per share SCHD is not too bad, and I would consider it an affordable ETF. Some of them are way up there. And like QQQ, VTI is pretty expensive. VGT is expensive. I mean, that's like sitting in the 300 range. So SCHD as an ETF sitting at $70.99 is not too bad. It's less than VIG as well. And its dividend is pretty consistent, but there are some things. I'm going to go over the dividend with SCHD, and we're going to look inside the portfolio. There are some concerns with me. So let's check that out. So on their website, Schwab U.S Dividend Equity ETF, they have an expense ratio of 0.06%. That's not bad. So one thing that's always a turnoff with me with ETFs or covered call ETFs is this expense ratio. So that means you get pretty much money taken out for being a shareholder or an owner of that ETF. So remember, in the long run, you get money taken out. That's why I prefer dividend stocks individually or stocks over ETFs overall. The fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones U.S Dividend 100 index. This is one thing that's very, just remember this for thought. This is still a little concerning. They track an index focused on the quality and sustainability of dividends. The fund can serve as the core or complement in a diversified portfolio. So it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So remember that. So right here, this is nice. Their 5-year earning growth is 15.14%. The return on equity is 38.44%. Price to cash flow ratio is 9.18. Price to book ratio is 3.66. Price to earnings ratio is 13.86. So here's our sector weightings, percentage of portfolio as of 3/21/23. Diversification is always important, because if one sector, one stock takes a big hit, guess what? Everything else kind of backs it up or absorbs that, and then it's fine. So that's the one thing. Strength in numbers is always important with ETFs. That's why with VTI, if Apple takes a hit one day, guess what? There's a lot of other stocks to back it up. So industrial 17.8, healthcare 16.3, financials 14.1, consumer staples 13.3, information technology 12.5, energy 9.3, consumer discretionary 8.1, communication services 4.9, materials 3.4, and utilities 0.3. Now let's look inside of these guys. And here's the thing that's concerning inside of these guys. So Pepsi is a great one. There's a lot of stocks that I own, and I have my M1 Finance dividend portfolio that Schwab has, but there's also some stocks that I got rid of in the past because I didn't like their dividend growth or there were dividend cuts. So they have some flaws which is one issue with the companies that they invest in. So here's Pepsi, that's a good one. Merck, Coca-Cola, AbbVie is a good one. Home Depot, Amgen, Pfizer I own. Cisco is a great one. Texas Instruments is fantastic. BlackRock, Lockheed Martin. ADP is a great one. Altria I just sold, and I'm going to rebuy. Now, the one thing with Altria is the revenue. I don't know if their revenue can back up their dividend in the long run. It's an 8% dividend yield last time I checked. You can correct me if I'm wrong. 3M, they've had some controversy. Now Ford, they added Ford. I'm still boggled by this because Ford is not really a dividend growth stock. And people really like Ford for like options trading and stuff, but this is not a good dividend growth stock. This is not a consistent dividend stock. They actually cut their dividend stock. So One Oak I own, T Rowe I own. Let's see, Kellogg's is a good one. Tyson I own, Fifth Third Bank. The other thing is with these regional banks like Regions Financial, there's a lot of concerns. Could there be a dividend cut with things going on? So some of the regional banks may have some risk of dividend cuts in the future. I hope not. That would suck for me because again, my goal is to get to 400 shares with Regions Financial, Huntington Bank shares, and KeyCorp, and KeyCorp's one of them. But this one is the big concern. Paramount. They have Paramount in their ETF. And the most recent news on Paramount is it's very disturbing. Let's go over that. So here's my concern. This is why I sold Paramount. So this is the problem with SCHD is some of the stocks inside its portfolio, just like Ford. So the dividend cut that happened with Paramount. Paramount Global slashed its quarterly dividend to 5 cents from 24 cents, the first time it lowered the payment since 2009. CEO Bob Bakish said the decision will further enhance our ability to deliver long-term value for our shareholders as we move towards streaming profitability. The company indicated what it expects the cut will result in $500 million in annualized savings. So they cut their dividend. So you have a stock that cut its dividend that's inside SCHD, and then you have AT&T. I'm sorry, not AT&T. You have Ford, who is inconsistent with their dividend. So you have that issue. So that's concerning to me. That they don't have, complete a solid portfolio. And I'm going to go over their dividend history, which is not always consistent as well. I still own these guys. Don't get me wrong. And don't get me wrong. There are more pros than cons owning SCHD. And that's why I own those guys. And they'd have to do something really stupid for me to get rid of them. Just like, Paramount, they cut their dividend. I got rid of them. And I always state, there'd have to be a drastic change with a dividend stock or ETF for me to boot them. So right here, 2011, let's look at their dividend trends. 2011, it was at 12 cents. That's right in December, okay? And then 2013, it was 23 cents. So you see some dividend growth. 2015, it was 30 cents, which is nice. That's why I have them in my traditional IRA, because if they keep on hiking their dividend, then I'll have an opportunity to use those shares to buy VHT or American Tower. But the problem is, look at the consistency. It went from 30 cents to 27 cents, 31 cents to 24 cents. And then it's in its 30s in 2017. Then it drops down to 26 cents and it jumps to 40 cents in 2018. Then it decreases to 35 cents. Then it goes to 42 cents. And then 2020, it jumps to 50 cents and it jumps to 60 cents. Then it goes to 58 cents in 2021. So it's 60 cents. And then look at this, 51 cents in March of 2022, and then it jumps to 70 cents, and then it jumps down to 59 cents. So the issue is there is some consistency with their dividend trends. But again, what I really like about these guys is they're competing with the S&P, and this is why I have them in my IRA. Dividend yield is 3.36 right now, according to NASDAQ. So if you bought one share, you made 238. So the problem that I don't like with these guys is what's inside of them. That's one flaw that I see inside of these guys. That's concerning. I think with them dropping Prudential and some other stocks, that was concerning. The other thing is with their consistency with their dividends. And of course, expense ratio is always a turnoff. But in the long run, you have some protection, at least if one stock takes a hit, then you have the other stocks to kind of back it up or absorb the blow. So I just wanted to go over some pros and cons that I found in SCHD. I own SCHD and I'm long in them, and I'm not giving financial advice for entertainment purposes, only disclaimer in the description. But I found some weak points and kinks in their armor. So they're not completely all that. And of course, making a risk is an investment is a risk. So you have to look into that. If you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. I hope you enjoyed this video, and I will have a video for you guys tomorrow. Take care.